Welcome to the Deep Dive. We're here to cut through the noise, really get to the core of what matters. And today, we're tackling a big one. It's a question probably everyone listening has thought about if they've ever, put money in the market. How do you actually make consistent profits? Not just when everything's going up, but, anytime. In any market condition. It's this dream, right? You see your money growing, you feel smart, secure, but then bam. Reality hits. There's just so much information flying around. The market's up, it's down, it gets volatile. And suddenly that dream feels pretty far away, maybe even like a nightmare. A lot of us, maybe like this average investor, Joe Smith, we're going to talk about, we jump in thinking, yeah, I can do this. It's not that hard, only to get completely caught out by some unexpected downturn. But what if? What if there was a roadmap? Not just for picking stocks, that's the easy part people think about, but a roadmap for mastering yourself, your own psychology, and the entire process of trading. And that's exactly what we're diving into today.
Our mission is to unpack what it really takes to pull profits consistently, whether the market's booming or busting. We're using some really profound insights from our source material here. The goal is to show you this holistic approach to trading success. It goes way beyond just finding the right stock. It really starts and ends with you.
Right. And just to be super clear, we're not here handing out hot stock tips. That's not the game. This deep dive is really for anyone who's curious about making smarter financial decisions, anyone who wants to understand the psychology behind why markets move the way they do, and maybe most importantly, how to build a really resilient approach to investing. Doesn't matter if you're totally new to this or if you've been in the markets for years and you're looking for that edge. We're going to explore why most people, the average investors, really struggle. And crucially, how you can position yourself for a much more informed and hopefully much more successful journey. It's about building a solid foundation, not just chasing quick wins.
Okay, let's set the scene then. Let's talk about this Joe Smith character from the source. It's a story that feels, incredibly familiar. So Joe retires in 2003. He's got a decent nest egg, $623,000. Smart guy, too. Advanced degree in civil engineering, reads a few finance books, watches the news. He feels pretty confident. Thinks he can get 10% annual returns, easy. He even starts thinking, an extra $5,000 a month from investments, that'll cover my $2,000 mortgage, no problem. His whole mindset, and the source quotes this, was that investing wasn't rocket science. He was even dreaming about getting his account back up to $1 million, where it was before the dot-com crash back in 2000. But then, 2008 happened. The big crash. His nest egg, it had actually recovered a bit, up to $683,000 early in 2008. But by the end of September, it plummeted, down to $484,000. That's a huge 29% drop in just that year. And he was down nearly 60% from his peak back in 2000. So Joe, like so many others, was worried sick. His account was heading towards $400,000. He's clinging to this advice from the gurus, don't sell unless you absolutely need the money. He's making mistakes.
The source points him out clearly. He just drastically underestimated how complex investing really is. And he completely failed to adapt when the market conditions changed so drastically. He treated it like it was simple, maybe like building a bridge without the right plans or training. And it almost led to, the death of his account, as the source puts it.
Yeah, and Joe's story, sadly, isn't unique at all. It happens all the time. And it brings up this really crucial question for all of us, for you listening. What does it really take to trade successfully? Especially when things get tough, like in these secular bear markets the source talks about. These things can last for decades, The source suggests we might still be in one that started in 2000, could go on for another 10 years maybe. It even mentions, and this is pretty provocative, some economic research suggesting the U.S. itself could be considered bankrupt if you look at debt and deficits a certain way. Now, whether you agree with that or not, thinking about these big picture factors shows that success requires a totally different way of thinking. A different approach to the market, yes, but maybe even more importantly, a different approach to yourself.
Okay, let's really unpack that, because the source does something pretty surprising right off the bat. Instead of diving into market strategies, it pivots hard to step one, working on yourself. It says everything you do, every single trade is shaped by your beliefs, and these beliefs basically create your reality. Now that sounds a bit philosophical maybe, but the source insists it's absolutely central to trading success. So why? Why is this internal work the first step? Before charts, before anything else, what's the risk if you just skip it?
It's a great question, and the source is emphatic. It must be done first. Because if you don't address your personal issues, your biases, your limiting beliefs, they will interfere. They get in the way of every other step. Your system development, your position sizing, your discipline, everything gets compromised. Think about it. The source gives this really striking example of the author's niece, brilliant woman, graduate degrees in art and biomedical engineering, objectively talented, beautiful. But her beliefs told her she was neither. She didn't see it. Her internal reality was completely different from the external evidence. That shows you how powerful these internal narratives are. So if your deep down belief is that trading is just gambling, or it's too complicated for you, or you're just not a money person, you'll probably subconsciously act in ways that make those beliefs come true. You'll sabotage yourself. The most costly mistake you make won't be picking the wrong stock. It'll be holding on to the wrong belief. Mastering your mind is where the real edge is.
Wow, okay, so it's not just a nice to have, it's truly foundational. And this is step one in their 5-step approach. Work on yourself and your personal issues so that they don't get in the way of your trading. Ooh, this is deep internal work. Before you even glance at a price chart or an economic report, it's about clearing the decks, mentally and emotionally, so you can actually see the market for what it is without your own stuff clouding the view.
Exactly right. And working on yourself, what does that actually look like in practice? Well, it starts with a brutally honest self-appraisal. The source describes a peak performance trader as someone who is totally committed to being the best they can be. They take absolute 100% responsibility for everything that happens, wins, losses, mistakes. It's all on them. And they're relentless about learning from those mistakes. It talks about having a purity of spirit, this ability to just, buy what's going up and sell when it stops. Simple, but not easy if your head's full of noise. And here's a bold claim. The source says psychology is far more important than methodology. Your mindset trumps your system. Why? Because our biases, our fears, our ego, they constantly make us focus on the wrong things. People might even resist a perfectly good trading method because it clashes with some internal belief they haven't examined. So the quickest path to better results isn't finding a new magical system. It's figuring out how you are getting in your own way. This means serious introspection, regularly checking in. What are my beliefs? Strengths, weaknesses. The book actually has a self-appraisal quiz to help with this. It categorizes traders great, good, average based on self-awareness, and it points out many average investors just want someone to tell them what to do. They want the profits without the personal heavy lifting. So for you listening, understanding where you stand right now, your current approach, that's the critical first step towards improving, moving beyond just wanting tips.
That's a really key distinction. And something else that's really jumped out at me was this analogy about commitment. The source says someone who isn't truly committed, they dance with any obstacle. But someone who's committed, they just move around it. Because the destination, the goal, is what matters most. It uses the example of a bad sandwich. Imagine you've got a super important meeting. It's 2.5 hours away. You only have 3 hours. You grab a sandwich from a drive-thru. It's awful. What do? You probably complain, toss it, get on with it. Minor annoyance. But what if you have absolutely nothing else planned for that day? That same bad sandwich. It can turn into a whole campaign. Weeks of complaining, writing letters. It becomes the focus because there's no overriding commitment. And that applies directly to trading. A loss, a setback. If you're committed, it's data. You learn, you adjust, you move on. If you're not really committed, that same loss can become the excuse to quit, to abandon the whole plan.
Absolutely. And that flows right into what might be the single most important trait. Personal responsibility. The source is crystal clear. You are the most important factor in your trading success, not the system, not position sizing, definitely not the market itself. You aren't trading the market, technically. You're trading your beliefs about the market. The marble game illustration hammers this home. Remember that. People play a game drawing marbles. Some win, some lose, some go bankrupt. When people go broke in that game, what do they blame? Often it's the game, or the person pulling the marbles, or bad luck. But the source points out the real reason, almost always, is internal. I risked too much money on some trades. My position sizing was wrong. It's about owning your decisions. All those common excuses, this game is rigged, I'm just not cut out for this, I'm an idiot, they're just excuses. They don't help you get better. The productive alternative is to ask yourself, using this NLP idea, is this belief I'm holding useful? Is it actually getting me closer to my goal? Is it working? If the answer is no, you change the belief. Embracing that responsibility, truly owning your results, it's incredibly freeing.
Okay, so how do we actually do that? How do we change those deep-seated beliefs? The source gives a really practical tool, the belief examination paradigm. Sounds fancy, but straightforward. You literally write down, say, 100 beliefs you have about trading, money, yourself, whatever comes up. Then for each belief, you ask 6 powerful questions. 1, who gave me this belief? Parents, teachers, media. 2, what does holding this belief get me into? What actions does it make me take? 3, what does it get me out of? What does it let me avoid doing or facing? This is often key. 4, how does it limit me? 5, is this belief actually useful for achieving my goals? And 6, can I change it? The answer is usually yes. The source uses the example belief. Stock selection is the most important aspect of trading. Running that through the questions reveals. It gets you into spending hours researching stocks, reading analyst reports, but crucially, it gets you out to do the hard work of self-analysis, or focusing on your exit strategy, or mastering position sizing, but limits your understanding of what actually drives profit. Conclusion, not a useful belief. For many investors who've been taught stock picking is everything, this exercise is a total game changer. It helps you dismantle those limiting structures.
And once you start examining beliefs, you naturally come to this idea of embracing polarities. The world just works in opposites, right? Good and bad, up and down, hot and cold, profits and losses. The source argues that the key is to make both sides okay. You have to be okay with profits, obviously, but you also have to be okay with losses. You simply cannot be a consistently successful trader if you're not willing to accept losses as a normal, inevitable part of the process. What happens when a loss isn't okay? When it feels like failure or proof you're bad at this, people resist taking the loss. They hold on, hoping it'll come back. They let small losses turn into huge, account-crippling ones. The anecdote about the real estate investor is perfect. Holding on to a losing property because I haven't gotten my money back yet, while at the same time selling a winning property quickly because I lost in the other one. Gotta lock in this profit. It's classic loss aversion. It highlights that psychological trap, resisting losses, needing to be right. If you don't make peace with losses, they will absolutely dictate your actions and destroy your results.
That makes so much sense. It's about detaching the ego from the outcome, which leads nicely into the next idea. Trading through mindfulness. And this isn't just about sitting cross-legged and chanting, although meditation is part of it. The source draws on the work of Ellen Langer, the Harvard psychologist. Mindfulness in this context means actively, continually, creating new categories, not getting stuck in rigid thinking, welcoming new information, even if it contradicts what you believe, looking at things from multiple perspectives, not just your own, controlling the context, reframing things, and crucially, putting the process before the outcome, focusing on executing your plan well, regardless of the result of any single trade. So instead of a rigid thought like, the market went up yesterday, so it must go down today, mindfulness encourages you to think more detailed thoughts. Consider different players, different factors, break old mental shortcuts. Most people filter information, right? We ignore stuff that doesn't fit our view. Mindfulness is about being more receptive. It's also about seeing things from the I position, how it affects me. The other position, how it affects the person on the other side of my trade, and the neutral observer position. And controlling context, like, is buying a trading course an unnecessary expense? Or is it essential business development to avoid much bigger losses down the road? It's how you frame it. The source gives practical exercises too. Daily meditation, keeping a trading journal that includes your thoughts and feelings, actively trying to imagine the other side of your trades, seeking out information that challenges your views. These are concrete steps to become less reactive, more adaptable, and ultimately a more mindful trader.
Right, and becoming more mindful helps you deal with that voice inside your head, what the source calls your inner interpreter. We all have it, right? That running commentary that frames everything that happens to us, often negatively. The source gives an exercise to actually visualize this voice. Where does it seem to come from? Whose voice does it sound like? Often a parent or a critical teacher. Then you identify its typical negative statements. You'll never get this right. This is too risky. And consciously rewrite them into positive, optimistic ones. The goal is to make this interpreter work for you, not against you. Remember Bill from the source? His inner voice kept playing his spouse's criticism about trading being just gambling. That constantly undermined his confidence. This exercise helps you catch those limiting narratives, realize they're just interpretations, not objective reality, and start to change them. Gain control over your emotional responses. When you do that, you suddenly feel much more in control. You can turn that inner critic into an inner coach, a supportive friend.
That's a really practical technique. And another powerful one mentions the power of dissociation. This idea, apparently inspired by people like Einstein, is about mentally stepping outside yourself to get a different perspective. Most of the time, we live in an associated state. Our feelings, our beliefs, they feel totally real, like they are reality. It's hard to be objective when you're right in the thick of it. But dissociation means you, say, imagine watching yourself from across the room, or maybe watching a movie of your trading day. As soon as you take that outside perspective, the experience changes. Thoughts and emotions become less overwhelming, less intense. So the practical exercise is replay a difficult trading situation, maybe a big loss or a moment of panic, but watch it from that dissociated viewpoint. Observe yourself without judgment. Then imagine that you on the screen having new resources, maybe more confidence, more calmness, clearer thinking. see yourself handling it differently. Finally, you mentally step back into that new, empowered version of yourself. It's a technique to help shed those unhelpful emotions tied to past events and shift your performance by giving you a fresh, objective viewpoint.
And that's incredibly useful when you hit those inevitable stuck states. We all get there. When you feel stuck, what do you usually focus on? The problems, right? The lack of money, the losing streak, the confusing market. And focusing on the problems just generates more negative feelings, guilt, anger, frustration. It's like a mental stop sign. You get caught in this internal conflict. Part of you wants the goal, another part wants to avoid the pain or fear associated with trying. You just oscillate. The Source offers simple ways to get unstuck. First, just relax. And then, maybe counterintuitively, move opposite to your instinct, like steering into a skid. If you're feeling frantic about needing to make a trade, maybe the opposite is to step back, make it okay not to trade, and work on the feeling instead. Second, consciously shift your focus to what you want to achieve, not the limitations or problems. That immediately opens up your thinking. And third, focus on being the person you want to become. Instead of thinking, I wish I was a great trader, imagine yourself as a great trader. Step into that feeling, that beingness. The Source suggests this can create an almost instant shift in your mental and emotional state.
All this focus on internal states, beliefs, managing emotions, it leads to a really fascinating, almost philosophical question the Source raises. Does failure motivate you? It draws on this idea from Jerry Stocking's book, Laughing with God, suggesting that maybe, just maybe, we're actually motivated by the possibility of failure, the uncertainty. Think about it. If you had a system that was 100% accurate, guaranteed winner every time, you make $10 billion in a year, no stress, no risk, would trading still be interesting? Would it be fun? The Source provocatively suggests maybe not. Maybe it's the uncertainty, the challenge, the risk of not succeeding that actually keeps us engaged. Ed Seykota, the famous trader, observed that people tend to get exactly what they want out of the market. Maybe that's excitement, maybe it's drama, maybe it's punishment, maybe it's just justification for feeling certain emotions. So it's a deep question for you, the listener. What are you really seeking from the market? Is it just the money? Or is it the game itself, the challenge of the dance with that inherent uncertainty?
And understanding what truly motivates you can lead to a profound shift. It connects to this idea of having no requirements to be happy and finding the joy of being. What if genuine happiness doesn't come from having more stuff or doing more things, but simply from being content in the moment? The Source poses the question. If you were infinitely wealthy, what would you actually do with your time? Would having 10 times more money truly make you 10 times happier? Probably not. It quotes something powerful. If you cannot be perfectly content with nothing, you obviously cannot be content with anything. This suggests we often chase these external goals, we value things just because they're rare or expensive, and we mistakenly identify ourselves with our possessions. The example of the guy with the $250,000 car is telling. He doesn't really enjoy driving it because he's terrified of damaging it. His sense of self is tied up in the car. An accident feels like he got dented. Good traders, the Source argues, often thrive on simplicity. They find joy in the process, in life itself. They go with the flow more easily. They don't need to be right all the time, or feel like they have to work incredibly hard. Simple tips are offered. Practice giving up the need to be right. Add novelty and fun into your life outside trading. Simplify your trading rules. Spend some time deliberately doing nothing. Make a new friend. This whole perspective aims to free you from that constant chase for external validation, allowing for a much clearer, calmer, and more joyful approach to trading and, really, to life.
So if that lighter, more joyful state is actually beneficial for trading, how do we cultivate it? The Source offers these practical vitamins for your soul, like daily supplements for well-being. First one, focus on the moment. Mark Twain's quote comes to mind, worrying about things that never happened. This vitamin is about letting go of past regrets and future anxieties by really grounding yourself in the present, appreciating what's good right now. Maybe spend 15 minutes daily just fully engaging your senses with something simple and beautiful. Second, spend some time laughing. Seriously, it mentions Norman Cousins, who famously used laughter therapy as part of his recovery from illness. The advice: make a conscious effort to laugh more. Watch funny movies, tell jokes, hang out with kids. Even forcing a laugh can start to shift your mood. It's powerful stuff. Third, give it to God or use a God box. This is for releasing worries you can't control. Write down what's bothering you on a piece of paper, put it in a designated box, say a little prayer, or just mentally release it. Thank the universe or God for handling it. And then this is key, consciously let it go. Try to forget about it. It's amazing how often problems seem to diminish or resolve themselves when you do this. Fourth, give thanks for your blessings. Instead of always looking for what's wrong, actively focus on what's right. Keep a gratitude journal. Every day, write down 5 things you're genuinely thankful for. It can really shift your perspective and lighten your spirit. 5th, follow your bliss. This is Joseph Campbell's idea, doing what genuinely brings you joy and energy. The author shares a personal story about quitting a soul-crushing job, taking a leap of faith to hire a secretary he couldn't technically afford, and how following that bliss led to greater success. Ask yourself, what activities do I love? What drains me? Lean into the things that energize you. And finally, commit to love and meditate and listen. Make decisions from a place of compassion and love rather than fear. And meditate daily, even just for a short time, to quiet the mental chatter, become aware of your thoughts, and tap into your intuition and creativity. The source also recommends deep breathing exercises, specifically a 1.4.2 ratio inhale for a count of, hold for 4, exhale for 2. This is said to have profound physical benefits too, like boosting the immune system. The story of the engineering professor who became a successful trader by trusting his inner guidance after meditation really underscores the potential here.
Absolutely. And alongside these more, let's say, spiritual or psychological vitamins, there's the need for practical discipline. Discipline in meeting your goals. The key here is to break down huge, intimidating goals into small, manageable, achievable steps, like climbing a mountain one step at a time. Make specific commitments, not just, I'll trade better, but I will follow my exit rules on every trade this week. Keep a diary or log of your accomplishments, focusing on progress, not just perfection. And crucially, the source says, make it okay to give in occasionally. This is huge. A setback isn't failure. It's not the end of your resolution. If you view a slip-up as total failure, you'll likely just give up. Instead, see it as an opportunity to learn, why did I slip? What can I do differently? Forgive yourself and get back on track. Another vital piece is removing stored charge, dealing with emotional baggage. Our limiting beliefs often have this emotional energy attached to them: fear, anger, guilt, shame, rejection. We suppress these feelings, we don't want to feel them. So we develop these internal parts whose job is basically to prevent us from feeling that pain again. But these parts often end up causing self-sabotage in the process. The source gives 3 exercises to release this stored emotional charge. One is simply welcoming the feeling when it arises instead of fighting it, just allow it to be there. Another is a technique to just mentally release the feeling. And the third is the park bench technique, where you actively commit to fully feeling a dominant negative emotion like fear or anger for a set period, maybe 10-15 minutes, without judgment until it naturally starts to dissipate. These exercises aim to neutralize the emotional energy behind those limiting beliefs, making it much easier to let them go and adopt more useful ones.
Okay, we've covered a ton of ground on this internal work. Beliefs, emotions, mindfulness, discipline, releasing baggage. It's a lot. So a really practical question comes up. How do you know when you've done enough self-work? Is there ever an enough? How do you gauge progress?
That's a really important point. And the source acknowledges that self-work is essentially a lifelong journey. There's no final graduation ceremony. However, it does suggest a key milestone, a point where you can feel you've made significant progress. That milestone is when you've consciously worked through at least 5 major personal issues. And this is critical, Lasif. You can clearly articulate how you transform them. The source gives examples of good versus unacceptable answers when asked about this. An unacceptable answer might be blaming circumstances or others, or just saying, I went to therapy, without showing any real self-awareness about how you contributed to the issue or how you changed. A good answer demonstrates deep self-awareness. It explains how you produce the issue. A.g., my insecurity drove me to work hard, but it also made me ignore warning signs in losing trades. And it explains the internal shifts you made to resolve it. A.g., by working on my self-esteem, I learned to accept losses without feeling like a failure. It's about taking responsibility, understanding your patterns, and being able to explain the transformation from the inside out. That level of self-awareness is the real benchmark.
All right, so once you've embarked on that crucial journey of self-work, step 2, according to our source, is to develop a working business plan. And we're not talking about some document you write once to get funding and then stick on a shelf. This is meant to be a living, breathing guide for your entire trading career, a detailed map.
Exactly. Step 2, develop a business plan as a working document to guide your trading. It's dynamic, something you revisit and update. And the source makes it clear this plan isn't just about the trading itself, it actually supports all the other steps. It helps you understand the big picture context we talked about, those major market influences, and gives you a framework for staying on top of them so you know when conditions are changing and your approach might need to adapt.
And this plan is incredibly comprehensive. It's not just financial projections. The source outlines 13 distinct sections, 14. That tells you how seriously this should be treated. It includes that crucial self-assessment we just discussed, the big picture market overview, defining your specific objectives, detailing your trading strategies for different market types, your position sizing rules, a plan for managing your psychology, how you'll handle stress, fear, greed, your daily routines and procedures, an ongoing education plan, a worst-case disaster plan, your budget and income tracking, outlining all your other necessary business systems like data feeds, research, client relations if applicable, how you personally relate to and manage these systems, and finally, specific strategies for preventing mistakes. Whew, that level of detail really forces you to treat trading like the serious business it is, not just a hobby or a punt.
Absolutely. And a key starting point within that plan is crafting your mission statement. Why are you doing this? What's the ultimate purpose behind your trading? Is it wealth creation, financial independence, managing other people's money? The source emphasizes needing clarity here. It uses the example of maybe managing money for friends and family. Is that just a casual distraction? Or is it a deliberate mission-critical step towards, say, eventually launching your own hedge fund? If it's mission-critical, then your business plan needs to reflect that. You need to allocate specific resources, time, capital, set up proper accounting, have a feedback loop to track progress. Without that clear mission, your efforts can easily get scattered, and you won't know if you're actually moving towards your real goal.
Okay, mission defined. Then you move to setting clear objectives. And again, the source makes it clear these aren't generic. They have to be specific and measurable. Using the marble game simulation again, shows objectives can vary wildly. Are you trying to maximize the probability of making a profit, even if it's small? Or are you trying to minimize the size of your maximum drawdown? Or maybe minimize the chance of ever losing, say, 20% of your starting capital? Your specific objective will directly shape the kind of trading system you develop and, crucially, the position sizing rules you use. You need to define what winning looks like for you.
And underpinning all of this is understanding your market beliefs. We keep coming back to beliefs. Because, as the source states, what you fundamentally believe about how markets work will dictate how you trade. There's no escaping it. It gives contrasting examples. Do you believe the market is a dangerous place, likely to take your money? Or do you believe you can easily make money in the market? The fascinating thing is, the source says, whatever you believe, you will likely be right because your beliefs will guide your actions to create that reality for you. This directly impacts your trading style. If you have a deep-seated belief like, how could I possibly buy a stock that just made a new high? That's crazy. Then trend following is going to feel deeply uncomfortable, probably impossible for you to execute consistently. Or if you believe, I need to make money every single day, then value investing, which often requires patience while waiting for undervalued stocks to turn around, is going to clash horribly with that belief. You can only trade comfortably and effectively what aligns with your core beliefs. That's why knowing them is non-negotiable. The source even lists the author's personal market beliefs as a template to get you thinking about your own.
Right. And related to beliefs about how markets work is understanding the current environment, grasping the big picture. This isn't about predicting the future, but about understanding the long-term trends and major forces at play, so you don't get blindsided by big shifts or caught up in bubbles. The source identifies 6 major factors to consider. First, that U.S. debt situation we touched on earlier. The source cites a study suggesting the scale of the debt is a major, perhaps underappreciated long-term factor. Again, reported neutrally, but presented as significant context. Second, the idea of secular bear market, these long cycles, maybe 15, 20 years, where the overall market might make little headway, driven by things like PE ratio compression. The source suggests the cycle starting in 2000 might still have years to run. Third, keeping an eye on changes in rules and regulations. Think about how decimalization changed market making, or how pattern day trader rules impact retail traders. These can dramatically alter the game. Fourth, this interesting observation about the tendency for human beings to play a losing economic game. It highlights how even sophisticated players, like banks leveraged 30-to-1 before 2008, can fundamentally misunderstand or mismanage risk. The source then provides a really concrete example with its market type analysis of the S&P 500 during 2008. It broke down every week based on price trends, using a 13-week window, and volatility, using ATR average true range, classifying weeks as, say, volatile bear or sideways quiet. Looking at that data for 2008, it becomes incredibly clear that a regular big picture check using this kind of analysis would have screamed danger or stay out, go short for most of the year. It's a powerful illustration of how understanding the current market type is crucial for strategy selection.
And to manage all this information and stay on track requires structure. That's where developing daily procedures comes in. A solid, consistent routine is absolutely essential for peak performance. And it's not just about looking at charts before the market opens. It includes things like a pre-trading self-assessment. How am I feeling? Am I stressed, tired, overconfident? Am I fit to trade today according to my rules? It includes specific strategies you'll use to prevent common mistakes. Meticulous record-keeping tracking, not just your trades, but your thoughts and reasons for taking them. Regularly monitoring your key performance stats are multiples, expectancy, win rate, drawdowns, knowing your numbers cold. And it even includes daily self-care, eating well, exercising, maybe meditation or other spiritual practices. These aren't luxuries, they support your mental and emotional resilience. The source strongly recommends using checklists for these daily routines. It helps ensure consistency and reduces the chance of errors creeping in due to forgetfulness or complacency.
Checklists make sense. And part of that structured preparation is the worst-case contingency planning. This sounds intense but necessary. It's described as a creative brainstorming exercise. You sit down and think about everything that could possibly go wrong. The source breaks it into categories: personal urgencies, like a family crisis pulling you away from the screen; market disasters, think 1987 crash, 9/11 flash crashes, events the source flags as previously unimaginable; equipment or data failures, internet down, platform crash; major life changes, job loss, divorce; psychological meltdowns, breaking all your rules; even problems with your broker. And the source includes this funny illustration of ninjas literally stealing your computer. Just to emphasize, think outside the box. Prepare for the truly unexpected. The goal: list at least 100 potential problems. Then for each one, brainstorm 3 possible solutions or responses. Finally, decide on the most effective response and rehearse it mentally until it becomes almost automatic. This isn't about being paranoid. It's about preventing panic and ensuring you can act rationally when things inevitably go sideways.
Exactly. And that rehearsal piece is key. Mentally rehearsing your disaster plan. Because what happens under extreme stress, your rational brain kind of goes offline. Blood flow shifts, you revert to fight or flight, your conscious processing power plummets. Mental rehearsal trains your unconscious mind, like that world-class cyclist mentioned who practiced crashing scenarios over and over. When he did crash, his body knew exactly what to do instinctively, saving him from serious injury. It's the same in trading. If you've rehearsed how you'll react to a sudden market crash or your internet dying mid-trade, your unconscious can execute the plan even when your conscious mind is reeling. This can save you financially and maybe even physically from the stress. So the process is: 1. Have your trading plan, including exits. 2. Brainstorm what could derail it. 3. Mentally rehearse your plan response until it's second nature. This prepares you for those black swan events, those things outside normal expectations, the stuff that wipes unprepared people out.
Okay, planning for disaster. But also planning for smooth operation. The source talks about needing systems beyond trading systems. It uses the analogy of a fast food restaurant. They don't just have a system for cooking burgers. They have systems for customer service, cleaning, inventory, everything. A trading business needs the same comprehensive approach. Systems 4. Customer relationship management if you manage money for others. How do you market? How do you communicate results, especially bad ones? How do you manage client expectations and emotions? Back office management, tracking everything, client details, account statements, performance metrics, bookkeeping, compliance. Data management, ensuring reliable, clean data feeds, having backups, knowing how to handle data errors, using continuous futures contracts correctly, and ongoing research, constantly developing and testing strategies for all the different market conditions, those 6 types: bull, bear, sideways, quiet, volatile. You can't just have one strategy and hope it works forever. These systems are the operational backbone. They let you focus on trading effectively.
And thinking systemically like this helps you understand where you fit in the 4 quadrants of traders. This adapts Robert Kiyosaki's cash flow quadrant idea specifically for traders. It's about your mindset and how you generate income. First, the employee trader. They work for a system, usually at a bank or institution, motivated by salary, bonus, security. The source suggests they're often the worst traders long-term because they're trained to avoid mistakes at all costs, rely on being told what to do, and may struggle when markets get difficult. Second, the self-employed trader. They are the system. They value independence, rely on their own skill and hard work. This is where most independent traders and money managers start. But they often hit a ceiling limitations of time, energy, knowledge. They burn out or fail because they can't scale themselves. Third, the business owner trader. They don't just do the trading. They own and develop systems for trading. They automate processes where possible, maybe hire others to run parts of the system. Their focus is on consistency, building robust processes for everything, freeing up their own time to work on the business, not just in it. And finally, the investor trader. They invest in trading systems, their own or others, that generate returns without requiring their constant active involvement. Think Warren Buffett's approach, but applied to trading systems. Their money, or rather their systems, work for them.
That's a really useful framework. It helps you, the listener, identify where you might be now and maybe where you aspire to be. Understanding the mindset shifts needed to move from, say, self-employed, doing all the work, to business owner, building scalable systems, is a huge advantage. The source points out many professionals get stuck in that self-employed quadrant, focusing only on market calls and ignoring the business structure, which ultimately limits their success. Okay, deep breath. We've laid the foundation with self-work. We've built the blueprint with the business plan. Now let's get to the engine itself, developing a trading system. But the source stresses it's not just about finding a system. It's about finding a system that genuinely fits you.
Exactly. Step 3, develop trading strategies that work in various conditions. Notice the plural, strategies. The source argues strongly that trying to find one single magic bullet strategy that works perfectly in all market conditions is usually futile. It's a recipe for disappointment. Instead, the goal is to have different strategies tailored for specific market types. Maybe one for trending markets, another for range-bound markets, maybe variations for high or low volatility. And again, it comes back to beliefs. You can trade something easily only if it fits your beliefs. Your system has to align with your view of the market, your risk tolerance, your objectives. The core characteristics of any system, the way you measure and compare them, boil down to its R multiples. Remember, 1R is your initial risk. The distribution of your trade results, how many 1R wins, 2R wins, -0.5R losses, etc., tells you everything. It has an average outcome, expectancy, and a measure of consistency, standard deviation. These numbers reveal how easy or difficult that system will be for you to trade psychologically.
So, what are some of the core concepts or approaches these systems might be based on? The source outlines several, emphasizing that success isn't tied to one specific concept, but rather to believing in your chosen approach and applying it with low-risk ideas. There's trend following. Simple idea, buy things going up, sell them when they stop. Short things going down, cover when they stop. Don't predict, just follow. Fundamental analysis. Digging into supply and demand, economic factors, company health to predict future price moves. Like analyzing the market for rare stamps, limited supply needs rising demand. Value trading, finding assets that seem cheap or undervalued compared to their intrinsic worth, buying them and waiting for the market to recognize their true value. Band trading, or range trading, buying near the bottom of a defined price range, selling near the top, works well in sideways markets. Seasonal tendencies, trading based on predictable patterns that tend to occur at certain times of the year, often driven by underlying fundamental factors like inflows of pension money boosting stocks between November and May. And spreading, or arbitrage. Trading related instruments simultaneously to profit from price differences or relationship changes, like trading crude oil versus gasoline. Each of these requires a different skill set, a different mindset, and aligns with different beliefs about how markets work.
And within any of these concepts, you need specific setups, the conditions that must be met before you even consider entering a trade. But here's another counterintuitive point from the source. Setups are not as important as you think. The experience of the late 90s tech bubble bursting and the subsequent choppy markets through 2008 showed that relying on one type of setup, like buying tech breakouts, doesn't work consistently across different market types. So the myth that finding the perfect setup is the key to riches. The source debunks it. Setups are just the initial criteria. And there are tons of different kinds: chart patterns, head and shoulders, triangles, specific price sequences, fundamental data releases, volume spikes, using things like the ARMS index, looking at components like individual stocks within the S&P 500, volatility indicators, looking for squeezed ranges ready to break out, or even deep business fundamentals like Warren Buffett uses. Focusing excessively on the setup alone means you're probably neglecting the parts that really determine profitability, your exits and your position sizing.
Okay, if setups aren't the holy grail, what about entries? Getting into the trade at just the right moment. Well, here's where the source really flips the script. It talks about entering the market and the random entry revelation. It actually discusses research, including results from trader Tom Basso, showing that a system using random entries, yes, literally, flipping a coin to decide buy or sell, could still be profitable if, and this is the crucial part, it was combined with disciplined loss cutting, exits, and proper position sizing. That's mind-blowing for most people. All that time and stress spent agonizing over the perfect entry point. Maybe it's largely wasted effort. The source argues that the focus on entry, especially picking the right stock, is because we've been, in its words, brainwashed by the financial industry and media. The author shares his own painful story. Buying a hot growth stock at 16 as a kid, watching it soar, feeling like a genius, then watching it crash all the way to zero. His realization wasn't, I picked the wrong stock. It was, I didn't understand the rules for making money. It's like using a stop loss to protect capital.
It points to the original Dow Jones stocks, only GE was still in the index decades later. So just picking the right stock and holding forever isn't a reliable strategy unless you get incredibly lucky. The focus needs to be elsewhere.
So where does this myth of stock selection being paramount come from? The source of the myth. The source points a finger partly at the structure of the mutual fund industry. Most mutual funds have to stay almost fully invested because their charters say so. Their goal isn't necessarily to make absolute profit for you, but to outperform their benchmark index, like the S&P 500. And importantly, they typically get paid based on assets under management, AUM, not directly on performance. So their incentive is to gather assets, not necessarily to protect capital aggressively in downturns. They can't really practice dynamic position sizing or step aside to cash. In stark contrast, the source says, the really successful traders often leave the mutual fund world to become hedge fund managers precisely so they can really trade, meaning they can use shorts, leverage, cash, and crucially, position sizing. Their success comes from the core principles: cutting losses short, letting profits run, and practicing proper position sizing to meet their objectives. Stock selection is part of it, but it's not the primary driver the way it is for long-only, fully invested funds.
Okay, so if setups and entries are less critical than commonly thought, then the emphasis shifts dramatically to exits. Exits are the key to making money. Your very first exit decision is your initial stop loss. That defines your 1R, your initial unit of risk. You face a choice here: tight stops versus wide stops. Tight stops mean your 1R is small. You'll get stopped out more often, taking frequent small losses. But when you do catch a winner, the R multiple can be huge, like a 10R or 20R win. You might only need a low win rate, say 25–30%, to be very profitable. Wide stops mean your 1R is larger. You give trades more room to breathe, stay in them longer, increasing your probability of being right on any single trade. But your winning R multiples might be smaller. The choice depends entirely on your system, your objectives, and critically, your psychological tolerance for frequent small losses versus occasional larger ones. And exits aren't just about cutting initial losses, they serve other purposes too. Maybe reducing risk as a trade moves in your favor, trailing stops, maximizing profits, letting winners run but having a plan to lock them in, preventing giving back too much profit for profit protection stops, or even just exiting for psychological reasons, like reducing stress before a major news event. A trend-following system, for instance, might use a wide initial stop to catch the trend, but then tighten the stop significantly once the trade is, say, 4R in profit, to protect those gains while still trying to capture more upside. It's all part of the exit strategy design.
Which brings us back to the absolute necessity of thinking in terms of reward and risk, using R multiples consistently. Cardinal rule: you must have an exit point defined before you ever enter a trade. That determines your initial risk, your 1R. No exceptions. Then, every single outcome, win or loss, is expressed as a multiple of that 1R. So back to that $40 stock example, with the $10 stock example, with a $10 stock example, with a $10 initial risk, 1R equals $10. If you sell it for a $40 profit, that's a plus 4R trade. If you get stopped out for a $15 loss, that's a Necketal 1.5R trade. This R multiple language provides a standardized, objective way to measure and compare performance across different trades, different markets, different time frames. It's far more meaningful than just saying I made $500 or talking about 10 baggers. That 10 bagger, using the example's math, might actually be a 36R win. R multiples give you the true risk-adjusted picture. The source suggests a great exercise. Go back through your trading records. For every trade, figure out what your intended initial risk or R was. If you didn't define one at stake, maybe estimate it using your average loss. Then, calculate the R multiple for every single trade's outcome. This forces you to confront your actual risk-reward reality.
And doing that exercise leads directly into the next critical task: tracking your system's performance with R multiples. This is non-negotiable. The source recommends keeping a simple spreadsheet or table. Columns for trade details, date, instrument, initial risk, 1R in dollars, actual gain-loss in dollars, and the calculated R multiple. Just the act of filling this out forces you to: 1. Actually know your initial stop on every trade. 2. Define that 1R clearly. 3. Calculate the R multiple result for every single outcome. 4. Consciously think about reward to risk ratios before entering. Example is the potential reward at least, say, 3 times my initial risk. And 5, it makes it super easy to calculate your system's overall expectancy, which is just the average R multiple per trade, sum of all R multiples divided by the number of trades. That tells you on average how much you expect to make or lose per unit of risk taken. The source provides a detailed example. 40 scalping trades. The trader thought he had a decent system of about 60% winners, roughly 1 R wins and 1 R losses. But the R multiple analysis revealed a very different story. Half the total profit came from just one huge outlier trade, 15.25 R. There were also some surprisingly large losses, up to mid 4.25 R, hiding in the averages, and some nasty losing streaks. This highlights why just looking at win rate is incredibly misleading. You have to look at the distribution of R multiples. It also flagged potential psychological errors. Those losses bigger than 2R probably indicated rules weren't being followed, which could easily sink an otherwise okay system.
Exactly. That R multiple analysis reveals the true character of a system. And when you look at truly successful traders, despite using different systems, trend following, value, etc., they share common elements of success. They consistently trade what the source calls low-risk ideas. That doesn't mean no risk. It means ideas that have a positive expectancy when traded with proper position sizing and are designed for the current market type. They deeply understand the concept behind their trading edge. They always know their 1R, their initial bailout point before entering. They consciously evaluate the potential reward versus risk for every single trade opportunity. They understand the statistical properties of their system, its expectancy, its likely drawdown patterns. They actively manage their emotional responses. They don't let fear or greed drive decisions. They trade systems that genuinely align with their personal beliefs. They understand the importance of identifying the current market type. They take absolute total responsibility for their results. And maybe most importantly, they understand that not following their own system rules constitutes a mistake. The source emphasizes that the average cost of a single mistake can be huge, maybe 4R or more, easily turning a winning system into a losing one over time. Eliminating unforced errors is paramount for efficiency.
Right, avoiding those unforced errors. And related to that is overcoming the "it didn't work" mentality. How often do people try something once or twice, it doesn't immediately produce amazing results, and they just say, it didn't work, and abandon it? The source gives examples of clients dismissing potentially valuable ideas, maybe a new exit strategy, or a setup that produces high R multiple wins, but infrequently just because it didn't work right away, without digging into why. It contrasts this with Thomas Edison and the light bulb. He had thousands of failures, but he didn't just say it didn't work. He learned why each attempt failed, and that knowledge guided his next step. The lesson for you, the listener: when something doesn't work as expected, don't just discard it. Research why, understand the failure. That understanding itself is often the key to finding what will work.
And pulling all these threads together, self-knowledge, planning, system design, risk management, learning from mistakes, that's what it takes to have confidence. True, sustainable confidence in trading doesn't come from wishful thinking or a couple of lucky wins. It comes from deeply knowing yourself, your beliefs, biases, strengths, weaknesses. It comes from having clear, comfortable objectives that resonate with you. It comes from trading a system that genuinely fits your personality and beliefs. It comes from thoroughly understanding how your system performs statistically, not just on average, but in extremes, across all the different market types. It comes from having that detailed, rehearsed, worst-case contingency plan. And it comes from having solid daily procedures that help you execute consistently and prevent mistakes. Without that complete, integrated foundation, real confidence will likely remain elusive, easily shattered by the market's inherent uncertainty.
Okay, we've journeyed through the crucial internal work, built the business blueprint, designed a fitting trading system. Now we arrive at what the source presents as the ultimate lever, the true multiplier in your trading performance. Position sizing. This might be the single most critical element, yet it's often the most misunderstood or even completely ignored.
That's exactly right. Step 4 is explicit. Develop position sizing strategies for each system that will help you meet your objectives. This is the how much question. How much capital do you allocate to any single trade idea? The quality of your trading system directly impacts how aggressively you can size your positions. Remember, we talked about expectancy and standard deviation of R multiples. The source provides a guideline to system quality based on the ratio of expectancy to standard deviation. A low ratio, say 0.16 to 0.19, is considered poor but tradable. It might have a positive edge, but it's psychologically difficult due to inconsistency. A high ratio, 0.70 or better, is labeled holy grail territory, meaning the system is so robust and consistent that it becomes much easier to trade and to apply position sizing effectively. The author developed a metric called the system quality number, SQN, to quantify this, also factoring in the number of trades for statistical significance. A high SQN basically tells you the system is high quality and you have more leeway with position sizing. A key insight here: achieving a holy grail SQN for a system that trades all market conditions is incredibly difficult, almost impossible. However, the source notes, if you confine a system to a certain market type, then it isn't that hard to develop something that's in the holy grail range. This reinforces the need for multiple strategies tailored to market conditions, and the impact can be staggering. Remember the currency trader example? He had a system for a specific crisis condition that produced a 1.5 ratio double holy grail. Because he understood its quality, he could apply aggressive position sizing and turned $1,300 into $2 million in just 4 months. That wasn't luck. It was understanding system quality and leveraging position sizing.
That story is incredible. It really drives home the point that position sizing is more important than you think. Way more important than just picking the right stock. Most people focus there finding the next Apple or Google. Even academics often talk about asset allocation, but miss the core meaning in a trading context. The source mentions the Brinson study, 1991. It looked at pension fund managers and found 91% of their performance variation came down to asset allocation, defined as how much they had in stocks versus bonds versus cash. It was about the how much. Yet, incredibly, the source points out that even high-profile strategists sometimes write entire books on asset allocation without ever explicitly defining it as how much to put in each trade or mentioning position sizing models. It's a huge blind spot. Mutual funds, again, illustrate this. Being forced to stay 95-100% invested means they fundamentally can't practice strategic position sizing based on risk or opportunity. That's why the source predicts they'll struggle massively in prolonged bear markets. And let's bring back the marble game one last time. It's a perfect illustration. Everyone plays the same game, gets the same sequence of winning and losing marbles, the same R multiple distribution, with a positive expectancy of 0.8 R. Yet the results are wildly different. About a third go bankrupt, a third lose money, and a third make millions. Why? The only difference, apart from maybe psychological errors, is how much they chose to risk on each draw. Their position sizing strategy. It couldn't be clearer. Position sizing is the dominant factor in determining your long-term outcome, assuming you have some edge.
So, what determines how someone does size their positions? The source identifies 3 intertwined components. 1, the trader's objectives. We talked about this. Is your goal maximum growth even with high risk of ruin? Or is it capital preservation above all else? Your objective dictates the kind of risk you're willing to take. 2, your psychology. Your beliefs about risk, your tolerance for drawdowns, your fear of failure, your desire not to look foolish, these deeply influence how much risk you're truly comfortable taking regardless of what a model says. And 3, the trading system itself, which interacts with the position sizing model. A common framework here is the CPR model.
Right, the CPR model. Simple but fundamental for practical application. P is CR. Position size, P, equals the amount of cash you're willing to risk on this trade, C divided by the risk per unit, share, contract, etc., defined by your stop loss, R. Let's run through those examples again. They're helpful. Example 1, you have a $30,000 portfolio. You decide to risk 2% on a trade, so C equals $600. The stock is $50, and your stop loss is $5 below entry, so R, under the $5 per share. Position size P, $600, $5, 120 shares. Example 2, $40,000 portfolio. You're day trading, risking only 0.5%, so C equals $200. The stock is $30, your stop is super tight at 30 cents, so R equals $1.30 per share. Position size P, you call 230 cents equals 636 technical shares approx. Example 3, the trick question. You want to risk $500, C equals $500 trading soybeans. But the risk per contract based on your stop is $1,000. R on $1,000. P equals $500 on $1,000 0.5 contracts. Since you can't trade half a contract, the answer is you cannot pick this trade with your desired risk parameters. The risk per unit is simply too high for the cash you're willing to risk. This model forces discipline.
Exactly. And for beginners, a good starting point for that C, cash risk, is often the 1% risk rule. This is a common position sizing basic. It simply means you risk about 1% of your total account equity on any single trade. So your 1R equals 1% of equity. Crucially, as your equity fluctuates, the dollar amount you risk changes, but the percentage stays constant. This helps control risk during drawdowns and allows for compounding during winning streaks. The source shows an example. Start with $100,000, risk 1%, $1,000. Even if you hit a nasty string of 12 consecutive 1R losses, your account is down, but not out. You can still recover with subsequent wins because you didn't over-risk. It provides staying power. It's also worth noting there are different ways to calculate the equity you base that percentage on, types of equity models like core equity, total equity, etc. These details matter. And beyond the simple percent risk, there are many other different position sizing models, percent volatility models, optimal F, fixed ratio, and so on. It's a complex field. But the core purpose of position sizing remains the same. It's not just about survival. It's about tailoring your risk exposure to help you meet your specific objectives. There are, as the source says, an infinite number of ways to approach it, so you must consciously decide, who am I as a trader? What are my goals? What position sizing strategy aligns with those? And under what conditions might I adjust that strategy?
And to really see the impact of these choices, the source talked about meeting objectives with position sizing simulators. This is where it gets really powerful. They take a hypothetical system, 0.8 R expectancy, 20% win rate, not amazing, but positive edge, and run thousands of simulations using different fixed percentage risk levels. The goal is to see how changing the position size affects the probability of reaching certain objectives, like achieving a 100% return within a year while keeping the maximum drawdown below 35%. The simulation results are eye-opening and show huge trade-offs. If you try to absolutely maximize your average return, you might need to risk a crazy amount, like 19% per trade. The average outcome might be a massive 1,070% gain. But the probability of going bankrupt, hitting that 35% drawdown, is 98.7%, basically guaranteed ruin chasing max return. What if you optimize for the highest probability of actually hitting the 100% profit target? That might occur at a lower risk level, say 2.9% per trade. This gives you a 46.6% chance of success. Better, but still a 31% chance of ruin. High risk. What if your main objective is to minimize the chance of ruin? Keep it below 1%. The simulation shows you need to risk much less, maybe only 0.9% per trade. Your chance of ruin is tiny now. But your probability of hitting that 100% profit goal drops significantly, down to maybe 10.5%.
It's crystal clear from these simulations. Chasing maximum return is often financial suicide. Position sizing is the tool that lets you navigate these trade-offs. You can consciously choose a strategy based on your tolerance for risk and your specific goals. Just from varying one parameter, the percent risk the simulation generated 5 distinct, legitimate strategies, each optimizing for a different outcome: max return, max probability of success, min ruin, etc. That's the power. Now, even with tools like R multiples and simulators, there are limitations. R multiples don't easily capture correlations between trades taken simultaneously. Their accuracy depends on having enough reliable historical data. And they can be tricky for systems that scale in or out of positions. That's partly why the author developed the SysQN, system quality number, to provide a more robust measure of system quality that accounts for some of these factors. A higher SQN generally means you can be more aggressive with position sizing. But even with SQN, you still need to be cautious. Ensure your R multiple data is accurate. Be aware when market types change, invalidating past SQN scores. Account for correlations if you're trading multiple positions. It reinforces that even with sophisticated tools, constant vigilance, understanding, and adaptation are absolutely key.
Okay, we've covered the internal game, the business blueprint, the trading system engine, and the powerful multiplier of position sizing. Let's bring it all home now with the final part. More ideas for producing optimal trading performance. This is about sustaining excellence.
Right, and this ties directly into the fifth and final step in the source's framework. Monitor yourself constantly and minimize the number of mistakes you make. And remember the definition of a mistake here: not following your own rules. If you don't have clear written rules, which you should after doing steps 1 to 4, then almost everything you do could technically be considered a mistake because it's discretionary and likely driven by emotion. Constantly repeating the same mistakes is pure self-sabotage. By monitoring yourself, tracking your mistakes, understanding why they happen, usually psychological issues you haven't fully addressed from step 1, you can systematically work to minimize their frequency and impact.
And a key principle for enabling this consistency and minimizing mistakes is to keep it simple, the classic KISS principle. Our conscious minds just aren't built for extreme complexity, especially under pressure. Remember that 7 chunks of information plus or minus 2 limit. Trying to juggle too many variables, too many indicators, too complex a decision process in the heat of the moment, it just leads to overload and errors. Your capacity shrinks dramatically under stress. The source gives an example of a broker trader who is incredibly knowledgeable, but ranked in the bottom 1% for performance. Why? His life and mind were just chaotic, overwhelmed with information and conflicting ideas. The solution wasn't more information, it was radical simplification. Simplify goals. Adopt a simple, robust, long-term system that didn't require constant tinkering. Re-examine and simplify core beliefs. Often, less is more in trading.
And this idea of simplifying, of focusing on what you control, leads to a different perspective on the holy grail of trading. It's not some secret indicator, it's you. Economists are increasingly talking about behavioral finance, acknowledging markets aren't perfectly efficient because people aren't perfectly rational decision makers. But the source suggests flipping that around. Instead of trying to predict market inefficiencies caused by others' irrationality, focus on becoming efficient yourself. Think about the cost of mistakes. Let's say you have a system that, if traded perfectly, generates ADR per year. With 1% risk, that could be a 100% return. Great. But now factor in human inefficiency mistakes. If the average mistake costs you, say, 4R, which the source suggests is realistic, and you operate at only 5% efficiency, meaning you make mistakes frequently, you might lose 76R just from errors. That wipes out almost your entire potential profit. But if you can improve your efficiency, reduce those mistakes, get to maybe 60% or 80% efficiency, the impact on your bottom line is phenomenal. Reducing mistakes is the holy grail. It's about mastering your own execution.
That's a powerful reframe. And for those who master this and build a successful trading business, the source touches on miscellaneous ways to make money, beyond just trading your own account, especially when managing more capital becomes the challenge. First, develop new systems. Creating additional non-correlated trading strategies adds new, independent profit streams to the business. Second, find more markets. If you have a robust system, applying it to more markets, for example, trading 10 global indices instead of just one, can potentially multiply your R multiple generation, assuming the system works there and you manage correlation risk. Third, add traders. One person can only manage so much capital effectively with a given system. Adding skilled traders, who follow the systems, allows the business to scale its capital deployment. Fourth, make traders more effective. Coaching existing traders to improve their discipline and reduce their mistake rate, like getting that average mistake cost down, directly boosts the profitability per trader.
And these factors are multiplicative, not just additive. Imagine a small trading firm. 3 traders, each running 2 systems across 3 markets. Maybe each system market generates 60 RAR ideally, but the traders are only 75% efficient, losing 15R per system market to mistakes. The total R generated might be around 810R. But if they improve things, add more traders, more markets, more systems, and crucially, increase trader efficiency to 90%, that total R generated could explode to over 5,800R. It shows the incredible leverage that comes from optimizing the business of trading, not just the trades themselves.
So, scaling up, but always grounded in sound principles, like the need to avoid making predictions in the market. This feels counterintuitive to many. People think successful trading must involve accurate forecasting. Where's the market going next? But the source states clearly, echoing many top traders, the best ones, consistently making 50% plus annually, often explicitly say they don't predict, they react. Their success comes from 5 critical ingredients, none of which is prediction. 1. Following their system's signals without second-guessing. 2. Getting out quickly when the system says they're wrong, cutting losses. 3. Letting winning trades run to capture large gains, high positive expectancy. 4. Ensuring they have enough opportunities trades for their edge to play out. And 5. Mastering position sizing to meet their objectives and manage risk.
That's the core formula. Cutting losses short, writing profits hard, and managing risk so that you continue to survive is what really makes you money. It's a fundamental, almost visceral understanding that separates the consistently profitable from those forever chasing the next sure thing prediction. And it loops back to the cost of mistakes. We need to know how to prevent mistakes. The source gives sobering examples. A futures trader whose 11 mistakes over 9 months cost him 46.5 VAR, half his potential profit. An ETF trader whose 27 small mistakes cost 8.2 over a year, a 20% profit reduction. Errors add up and kill performance. So prevention strategies are key, like that daily mental rehearsal. What could go wrong today that might cause me to break my rules? Anticipate your triggers.
And the car accident story is such a stark reminder. This successful day trader, disciplined, profitable, but a sudden personal emergency, girlfriend's car crash, caused him to abandon his mental stops, and he wiped out a year's worth of profits in a single afternoon. It hammers home the need for that comprehensive, rehearsed, worst-case contingency plan. It has to cover the truly unimaginable market moves far beyond historical norms, sudden geopolitical events like 9/11, even bizarre things like squirrels chewing through your internet cable. Yes, the source mentions squirrels. You have to prepare for chaos and have an automatic response ready.
Absolutely. Prepare, simplify, execute. And finally, the source brings it all back to basics with a reminder. You cannot ignore the fundamentals. It concludes with a short quiz testing fundamental trading concepts. Things like, how do you calculate a 25% trailing stock? How do you determine the number of shares to buy using a 1% risk rule? Can you explain the difference between your total investment and your actual risk, 1R? Can you calculate R multiples correctly? The source is blunt. If you score poorly on this quiz, you have significant work to do.
It's a powerful reality check. It's a clear call to action for you, the listener. Master these foundational concepts, because if you ignore them, if you don't have this basic literacy of risk and reward, you simply cannot compete effectively in the long run. Hashtag outro. So after this deep dive, what does it all really mean for you? We've journeyed from the very core of your own beliefs in psychology through building a detailed business plan like a serious entrepreneur, to designing trading systems that actually fit you and the market conditions, and mastering that crucial how much question with position sizing. Becoming a truly effective trader, it seems, is this profound path of self-discovery, rigorous planning, and unwavering discipline. It's about building resilience, building a robust process, not just hoping for luck.
Exactly. It's definitely not about finding some mythical holy grail system out there that predicts the future and is never wrong. That just doesn't exist. The real holy grail, as our source compellingly argues, is actually inside you. It's the commitment to that continuous self-improvement, the willingness to work on your stuff. It's embracing uncertainty, not fighting it. It's the ability to operate with that pure, simple focus on executing your process well, trade after trade, detached from the outcome of any single event. That internal mastery, that efficiency, that's what truly separates the super traders from the rest.
Which leaves us with a final thought, something for you to really mull over. Considering everything we've discussed today, if the true secret to trading success lies less in predicting markets and more in mastering yourself and your process, then what simple foundational belief about yourself or about trading could you choose to consciously examine and perhaps change starting today? What single internal shift might unlock a completely new level of performance, not just in your trading, but maybe in your whole life?